Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell. Stocks are higher here. The Dow holding above that 50,000 level. Our very own Jared Blickley is standing by with all the headlines. Jared.
Get your Dow 51,000 hats, but probably not today just yet. We're looking at some very small gains here. Nevertheless, close to the open, within the first hour, the Dow notched a record intraday high. We'll see what happens into the close, but just looking up about 60 points right now. NASDAQ Composite is surging up 1%. Tech finally leading. We're going to take a look at the sector action in just a little bit. And the S&P 500 up about half of that, or 0.6%. Also want to point out the S&P 500 equal weight. That scored a record high, as did the S&P 600, that's small caps, and the S&P 400, so that's mid caps. So kind of a mix of all your caps in there, and I'd add micro to that. Micro caps doing well, up about 1% according to that index. And let's check out what bonds in the dollar are doing. Yields moving slowly, just to the downside a little bit, down 1 basis point in the 10-year to 4.2%. The 30-year down, not even 1 basis point, so just about break even at 4.85%. I was looking at the US dollar index, 0.8%, not a big move for stocks, but that is a huge move for currencies. Josh, you and I are going to talk about that later in the show, but let's take a look at that sector action in the large caps. As promised, there's XLK up 1.86% in last place most of last week. We'll take a look at what the semiconductors and software are doing in a second. Materials number 2, communications number 3, and that is the 3 that are over 1%. To the downside, we got healthcare, staples, and financials and consumer discretionary. So retail stocks largely both the stuff you need and stuff you want in the red today, along with healthcare. NVIDIA in the upper left up 3%, and we're seeing some outperformance in the mega caps, some of them anyway. Meta up 3, Microsoft up 3, Broadcom up 4, Tesla up 2. Let me just show you what the ARC disruption components are looking like. That is a whole lot of green. Haven't seen that in a little bit, so risk appetite is up. And then here's semiconductors. This has been a source of strength all year long, even last week. It wasn't terrible, but what was looking bad last week was software looking pretty good today. What SaaS apocalypse, right? There's Oracle up 10%, Shopify up 6%, Snow and Crowdsource up over 3%. A lot of outperformance here. And I'll just circle back to the Dow here. And we do see in the Dow kind of a mix between red and green. It looks like financials doing all right there with Goldman Sachs up 2%, but healthcare just flagging a little bit today. I'll send it back to you, Josh.
All right, thank you, Jared. We got a big week of data ahead of us with inflation and payrolls numbers on deck here with what investors can expect and what it could mean for the Fed. Our very own Jennifer Schonberger. Jen.
Hey there, Josh. We will get the January jobs report on Wednesday. That was delayed from Friday because we had that partial government shutdown that sort of pushed things back a couple of days. Expectations are for an increase of 70,000 on payrolls, with the unemployment rate holding steady at 4.4%. Now, the big question is going to be, where are those job gains coming from? Will we again see those gains coming from healthcare and social assistance, which would speak to perhaps some weakness in the job market? Now, it is the January jobs report in which we typically get these benchmark revisions. That is that we're going to get revisions to the data that was released in 2025, and the expectation is to show weaker job growth. We already know that we would get revisions after monthly numbers that showed a downgrade. So we could see even further weakness, but that will be in the rearview mirror for 2025. The bigger question is, of course, what is happening going forward this year? Now, we are also going to be getting some key inflation data that was also pushed back because of that partial government shutdown. We're going to get the consumer price index, a reading on that for January on Friday. Expectations there for 2.5% increase, both the headline and the core that adjusts for those volatile food and energy prices. Month over month, core seen inching up 0.2%. If we were to get that, that would be welcome news. However, the whispers on Wall Street are that they expect that number to come in perhaps a bit hot because in recent Januaries, we have seen just that happen. Perhaps it's partly because of the calculation, but questions this January will also come from, if it does come in hotter than expected, are we seeing an increase because of tariffs from the president? It is typically the month of January that firms look to reset prices, and that is something that the Federal Reserve is watching very closely. Josh?
And Jen, while we got you, so polymarket traders, they're currently betting, Jen, on an 85% chance the Fed will hold rates steady at the next meeting. Could the data we get this week, Jen, you think that could impact that view?
I think they have it right, Josh, because the one thing that Fed officials are focused on right now is the job market, and is there going to be further deterioration in the job market? You get a payroll number of 70,000, even if it is coming mostly from healthcare and social assistance, with the unemployment rate holding at 4.4%, I think officials are going to think that there are signs that the job market is stabilizing. Remember, they did 3 rate cuts, insurance cuts, if you will, at the tail end of last year. So they're going to be waiting for those. We know monetary policy operates with a lag effect. So we're going to be waiting on those to sort of kick in. So if those numbers come in line, don't see the Fed cutting. They're probably likely to hold steady. Now, on the inflation front, I think they're going to be more focused there on that number, because if that comes in hotter than expected, all the more reason to hold. If it does come in at 2.5%, that is going to be welcome news for them. The question, though, is there a trend that we're seeing? They need to see a decisive trend lower that they think is sustainable to start the cutting process again.
All right, Jen, thank you. And you can find more Fed predictions and other bets by going to the Yahoo Finance Predictions Market Hub, powered by Polymarket. Well, the U.S. industrial and manufacturing economy is showing signs of a rebound, setting up what our next guest calls a rotation into old economy sectors. For more, we're bringing out Michael Darda. He is chief economist and macro strategist at Roth Capital Partners. Michael, it is always great to see you, my friend. So let's start there. You see this in the industrial economy, our manufacturing economy. You do see a rebound there, Michael. Just walk us through it. What are the signs and signals to you of that?
Great to be on with you, Josh. Well, it's pretty incipient at this point. The PMI data was better than expected in January. The headline figure, as you mentioned, moved over that 50 threshold. Really, we've had a 3-year period where we've been mostly below 50. So almost a 3-year downturn in the manufacturing and industrial economy, looking like it could be coming to an end now. What was more exciting was the new orders index, which is more forward-looking, exploded upward in January to levels that we haven't seen since early 2022, when the Fed was, just about to start a rate hiking exercise that was much more dramatic than virtually anyone anticipated at the time. So it's incipient at this point, but as all of your listeners know, markets look forward. They don't wait for the data. And this rotation into so-called old economy, industrials, materials, stocks, energy, that's actually been underway since the fall of last year. So as of late October, when the Infotech Index made its last all-time high, these old economy sectors and some defensives have been leading the way.
What about the role of tariffs here, Michael? Because you do point out, tariffs delay this recovery. What impact did tariffs have, Michael, on U.S. manufacturing, and why could that effect, now be ending?
Yeah, absolutely. I'm glad you asked that question. So I want to make it clear to all the listeners, I am not making a mercantilist, trade protectionist, Smoot-Hawley argument for U.S. manufacturing reviving. I think we had an upswing underway as we were exiting 2024 that ended up getting delayed last year because of this tariff shock. And all you really need to do is to read the commentary in the ISM reports, and that will tell you all you need to know about tariffs. Yes, they are a tax. Yes, they've been a drag on manufacturing growth. Yes, they've increased input costs. And so they've created distortions, as they always do. Really effectively, we just pushed out that stabilization and recovery by about a year. But it is coming, and it's coming mainly on the back of Fed easing. In your previous segment, you were talking about the insurance cuts the Fed did last year, 75 basis points, but they also did 100 basis points of rate cuts the year before in 2024. So you have almost 2 full percentage points lopped off the Fed funds rate. And what is that doing? We now have a yield curve that's moved back into positive territory. Monetary growth, which was negative for an extended period of time, is now positive, albeit modest. So we're already seeing a turn in the leading indicators, and those leading indicators were consistent in moving with the industrial economy. So overall growth held up, even with all those Fed rate hikes that have now partially been taken back, but the manufacturing economy suffered, and that suffering looks to be coming to an end.
So in terms of what this means for investors, Michael, so you've been calling, for this rotation into the old economy sectors. Just in plain English, Michael, what do we mean by that? Like, which sectors would we be talking about?
Yeah, I think namely the sectors that have underperformed through this period of industrial weakness. Energy, huge underperformer. Materials, big underperformer. Industrials, also an underperformer until recently. So that's really what I mean in terms of old economy. And they represent just a tiny share of market cap, about 14%. The materials sector is 2% of total U.S. market cap. I mean, it's like nothing. There's no exposure there. So this theme could have some legs to it, and investors are really not positioned for it in any way. And just to be clear, I'm not bearish on tech. When we made this call in the summer of last year, the call was really that infotech valuations had moved up above a 30 forward multiple. That's kind of where we've been when pullbacks or corrections have happened in the past. And we just went through some valuation compression now on the infotech index. And so I'm not adverse to adding there. And I'm not bearish on tech. I just think that investors need to broaden their horizons a little bit and widen the portfolio exposure a bit. We don't want to just be loaded up on any one particular sector. And that sector now is dominating U.S. market cap, infotech and comm services, about 40% of the S&P 500. So you can have these stealth rallies underway, and it doesn't look like much in terms of the level of the index, because they just don't have the market cap to make a lot of noise.
Switching gears a bit, Michael, I want to talk about the metals too, because you talk about sort of kind of extreme gap you're pointing out between gold prices and industrial commodities. What's going on there, Michael, and why does that matter for investors? Walk us through it.
Absolutely. So there's been a ton of excitement with the precious metals markets. I mean, anyone listening to the show either owns gold or silver, or they've been watching it rise dramatically until very recently and wishing that they had been exposed. But if we look at these markets, what we see is a 6 sigma event, really something that should never happen statistically, or if it does happen, something's broken or you're into regime change. But what that means is that there's been such a tremendous outperformance on the part of gold and silver vis-a-vis industrial metals like copper and the like, or even energy commodities like oil, that our view here is the real upside is in the latter, not the former. If there's any kind of a rotation or reversion towards the mean, it means you actually want that industrial commodity exposure, you want that energy exposure. So even if you're an infotech investor, why not beef up the exposure to the energy sector? We keep talking about how we're not going to have enough energy to power all of this computing capacity that we need. Well, that's one way to play that scarcity story, but it's also a way to play a bit of mean reversion in metals markets.
Finally, Michael, you talk about Kevin Warsh here. Of course, that Trump has said, that's my guy. That's who I want in the Fed. You did a deep dive there for clients, which was a great read. I'm curious, Michael, given the U.S. economy's resilience here, do you think Warsh wants lower rates, Michael? And if he does, do you think he could actually, if confirmed, deliver on that?
Yeah, great question. He has a history of a hawk. meaning that he's typically been a critic of low rates. He's been a harsh critic of QE and large central bank balance sheets. So it's in his nature to be a bit more hawkish. Now, everything changes when you're lobbying for a job, and the president that has the power to appoint you explicitly and definitively says he wants lower rates. So I think within that context, Warsh has obviously probably given the president some assurances that he prefers lower rates. But like you said, it's all going to be dictated by the macro economy. If this rebound in manufacturing is kind of the front edge of a broader acceleration, especially if we see the labor market start to retighten, the committee is not going to go along with further rate cuts. They're on pause now, and the reluctance to do more will simply harden if the labor market starts to heat up again later this year. So he's going to have to be a consensus builder. Otherwise, it could lead to a series of embarrassing votes if that were not the case. We went through some of that history. There were really only two instances where a Fed chair has been outvoted by the FOMC. One happened under Paul Volcker in the mid 80s, and that was kind of just a temporary thing in terms of the timing of the rate cuts. And then another one under William Miller in 1979, where Miller just didn't really know how the Fed was supposed to operate and embarrassingly voted against a discount rate hike that the rest of the committee supported. So, Warsh is a very smart guy. He knows all that history. He's not going to go in there to stumble right out of the gate. And so if the data does not support further easing, then I'm afraid the executive branch might get pretty disappointed pretty quickly. And we've seen that movie before with Fed Chair Powell.
Michael, as always, so good to have you on the show. Thank you, sir.
My pleasure. Good to see you.
Coming up, Chipotle CEO drops by to discuss the Super Bowl, the consumer, and more. Chipotle got in on the Super Bowl fun, not with an ad, but by offering customers free food. The company announcing $1 million in free food to 100,000 customers during football's biggest night. This comes as Chipotle continues to struggle to bring more consumers in its doors. That stock is off over 30% in the last 12 months thanks to the recent slowdown. Yahoo Finance executive editor Brian Sozzi joins us now with Chipotle CEO Scott Boatwright. Sozzi.
All right, thanks so much, Josh. Scott, good to see you here. Off the jump, can you confirm that you gave away 100,000 free meals yesterday?
We did, Brian, and luckily enough, they were all gone in just a matter of seconds. And so, wish we could have given away more. I think the demand is pretty great, but thankful to our loyal consumers out there that worked really hard to find their way into a free code. And for those that didn't, we'll have another offer in the months to come. So keep an eye out for us.
Another offer. So you're going to give away another $1 million in food soon.
I'm sure at some point, Brian. I don't have a date in front of me, but it's something we like to do for our most loyal guests.
Now, of course, Scott, you are a public company. You're in it to make some money here for investors, for the company and stuff. You're not used to giving away free food. Why did you feel like you had to do this right now?
Not something we felt compelled that we had to do, Brian, something we just wanted to do. Our way of really hacking the Super Bowl and not running an ad this year. We did do an ad a couple of years ago. I think you recall it was a Can a Burrito Change the World. It was well received. It really communicated our brand in a unique way. So, we never know. The future holds for us. It could be another ad or another opportunity to give away free burritos.
Is that core consumer, what? I heard you on the earnings call a little while ago, about a week. 60% of that your customer base earns over $100,000 a year, average household income. Are we just at a point in the economy where that consumer, if you make over $100,000, hey, you just need some free food?
No, I think there's a bit of misinformation that's been communicated over the last few days. What I said distinctly on the earnings call is that 60% of our consumers' average household income is over $100,000 a year, and they're still spending in this tough economy. So we're going to lean into those consumers with brand innovation, menu innovation, and really give them more compelling reasons to come in. But we cater to everyone in all lifestyles, Brian. If you make under $100,000 a year, our entry point on our high protein menu is at $3.50. And then it scales up from there. You can get a side of protein for just $3.80. So we feel like we have an offering for everyone, no matter where you come from or your lifestyle or your household income.
Tell me why, and I hope I heard this right, you are about to test a happy hour at Chipotle.
we're going to give it a shot, Brian, and see what it looks like for us. We're calling it happier hour. So think maybe a couple of tacos and a beverage sometime during the middle day part. We'll see how it performs, and we feel like it's a compelling offer and it creates value for our consumer, then it's something we will certainly lean into. I'll tell you, the average price of a chicken burrito in the U.S. today is still under $10. And if you think about value the way I do, which is benefit over price, the best ingredients in the world, prepared in restaurant with classic culinary techniques, and at an abundance and a variety and a speed you really can't get anywhere else for under $10. That's value in my mind, Brian, for all people, regardless of income cohorts.
So a happy hour at Chipotle, I'm thinking we're not talking about liquor here. I mean, that's not what we're getting into, but what, 3 tacos and a drink for under $10?
So I don't know what it'll look like, Brian, so we have more work to do on exactly what we'll launch in the test. But we're thinking something probably lower than $10 that is really great value for the consumer. I think it's our way into really giving back to the community in a meaningful way and really expanding that day part to bring more customers in the restaurants.
Scott, you got to give some guac away for free here. I mean, come on, it's extra.
We work so hard to prepare our guac fresh every single day in our restaurants. We think it's an incredible value as it's priced, but our most loyal customers that are in the Chipotle loyalty program can get access to free guac pretty consistently. So we'd love to invite more people into our rewards program so we can reward our most loyal consumers.
There's so much focus, Scott, on Chipotle and value perception. I think investors have forgot how much you will be growing this year. How many restaurants will you be opening around the world today? And then also, too, I think they have also forgotten what you're doing to speed up your lines in terms of technology.
That's right, Brian. We'll open between 350 and 370 new restaurants this year. That includes about 15 to 20 partner-operated restaurants. We continue to expand with our partner in the Middle East. We're opening a couple of new countries this year. We'll open up in Mexico, Singapore, and South Korea, really expanding this idea of wholesome, nutritious food prepared in restaurant fresh every day at an affordable price point. We have been well received in the Middle East. Our restaurants are performing exceptionally well, and our partner there will double the size of their business this upcoming year. And then here in North America, as well as Western Europe, we're going to continue to grow and expand our footprint. And I think what we do is very unique, Brian. I talk about this a lot. We bring wholesome, nutritious food oftentimes to food deserts where people don't have access to food that's of our quality at our price point.
We, of course, are coming up on a jobs report. Jobs report this week, has it become easier to find the employees you need? You and I have talked about in the past how scarce restaurant talent is.
We've been very lucky, Brian. We don't have a staffing challenge at Chipotle, and we haven't had one in the last couple of years. We did launch a new AI tool. Her name is Avocado, who helps us with onboarding. The program really helped us reduce the time it takes to get a new hire in the restaurant by about 75%. And so it's helped us find the best quality candidates in the market. And I think our benefits that we offer are industry leading and are compelling. So when we get someone into our program that's purpose driven, that really wants to work hard and achieve something for themselves and their families, we create exponential opportunities because of our growth. And our rewards package offers a host of benefits. I won't go through them all. One I'm most proud of is a debt-free degree, 10 different universities, 100 different degrees. So you can come to work for us at Chipotle Mexican Grill, build on a career. Within just 4 years, you could be making over $100,000 a year. And oh, by the way, we'll pay for your college education.
Scott, that's good stuff. Before we let you go, let me just go back onto the value perception. Why can a company like McDonald's come out here with a dollar menu and promote the heck out of it and drive traffic? Is that type of menu just not something, given how your model is constructed, that you can do or you want to do?
Brian, I don't want to do it. Let me tell you why. I think the value of our offering is very compelling. Our food is worth, in my mind, every penny we ask someone to pay for it. I don't want to devalue our core offering. It's just not something that makes sense for us. Our most loyal consumers come to us because they want the best ingredients in the world, prepared in restaurant, fresh every single day, and again, in abundance and speed you really can't get anywhere else. If I think about pricing for us as relates to the rest of the industry, Brian, the industry right now is running about 4% pricing, meaning 4% higher than they were just a year ago. We're only running about 0.7% pricing this quarter. So we continue to work on our value gap as it relates to our peer group and ensure that we're giving the customer a compelling value every single day.
Full disclosure, Scott, I missed the Super Bowl ad, so I was not amongst the 100,000. Next time I'll have to catch it. Scott Boatwright, give me a heads up next time. Good to see you. Talk to you soon.
Great to see you, Brian. Thank you.
All right, thanks, Scott. Josh, back to you.
All right, thank you, Brian. Coming up, we talk the biggest highlights from Super Bowl 60. Don't go anywhere. Now time for some of today's trending tickers. We're going to start off here with Cleveland-Cliffs. Those shares dropping after its fourth quarter results. The steel company reporting a wider than expected adjusted EBITDA loss. Cleveland-Cliffs noting its performance in 2025 was negatively affected by persistently weak production levels from the automotive sector throughout the entire year. Also, Citi pointing out that shipments in the quarter were weaker than expected. Next up, Workday trading lower. That's after announcing a CEO transition. The company saying its co-founder and current executive chair, Anil Bhusri, will return as CEO. The shift comes as Workday focuses on leading in the rapidly evolving AI era. This change is effective immediately, with Bhusri stepping in as the company kicks off its fiscal year 2027. Finally, AppLovin on the rise after a short seller retracted claims tying one of the company and one of its major shareholders to financial crimes. The financial publisher is saying in a post on X that its claims were inaccurate and failed to meet the publication's standards. Capital Watch determined that due to an insufficient independent verification process, they erroneously associated that judicial document with the AppLovin shareholder. Well, the Super Bowl has come and gone, but there's a lot to unpack, from consumer spending to AI buzz. Yahoo Finance's Brooke DePalma joins now with a closer look. Brooke.
Certainly what we saw is what we pretty much expected here. Consumers spent more on things like chicken wings and snacks, as well as grocery items, along with TVs, actually. People spend more on TVs.
Yeah, well, you want the bigger TV.
Exactly, the bigger TV to tune into the big game on Sunday night. But in addition to that, we also saw this momentum leading up, with just consumers really being more realistic with just how much they'd spend. And so they ended up spending more, they ended up buying more. So all in all, consumers were willing to pay up this Super Bowl
So
yet
chips
again.
and dip. Did alcohol make the list? What did they say about that?
Alcohol didn't make the list. I wonder if
Interesting.
that's sort of this trend that we're seeing. People
Yeah, well, you
pulling
hear
back.
about that. You hear chatter about it, especially among the kids. What about AI? What about AI? Was that
Well,
there?
of course, this Super Bowl seems like it was dominated by not only the Seahawks, who took over, but the pretty big, significant win there, but also AI seems to have dominated the headlines. Adobe saying that it really reshaped their engagement with the big game, with people actually using AI to discover where exactly they can watch the game. And that was increased monumentally more and more year over year, because now AI seems like it's being the new search function. We're just using more and more ChatGPT and Google Gemini to research and search things like where can we watch the big game, as opposed to maybe more traditional searches as well.
What, did you see any AI ads during the Super Bowl
Just
that
a few.
got your attention?
Rumor has it that Josh Lipton did not watch the entire game.
No, I checked out. I did the first half, but I had no dog in that fight. I had no, the AI ad though that people were talking about, which was a good ad, which was the Anthropic ad. I don't know if you caught that. That was a great ad. So basically, if in case people didn't see it, you have this guy, and he's on like a pull-up bar, and he's like, how do I get, there it is. And you can see, smaller guy, right? He's looking kind of weak. I think people couldn't help but notice, was there a vague, broad resemblance to OpenAI's Sam Altman? I think so. You're kind of seeing that.
I actually didn't catch that.
Oh yeah, come on, that's a shot. And he's kind of making fun because he's asking ChatGPT here, hey, how do I get ripped up like you?
Yes.
And ChatGPT starts giving him answers, and then
at the end,
slips in an ad.
Yep.
And the guy's like, what?
But perhaps ChatGPT kind of using it to its advantage, because today OpenAI's ChatGPT announced that they're actually going to launch ads on their site. That was an announcement that ChatGPT had today. So while Anthropic took a shot at them, ChatGPT kind of using the opportunity to share the fact that they are going to have ads, and that's going to be a seamless experience that consumers will barely notice. But you can't help but notice something that I noticed was not only was AI a main conversation point within the ads, but GLP-1s was another one. that
While
got
you're
under
sitting
pressure.
there eating all your chips and dip.
I know, you're kind of like, wait a second, guys, this is not what I want to be seeing. Including him and hers, which actually is under pressure today. That stock after the lawsuit from Novo Nordisk, in addition to the FDA statement. But you see this was, I believe, Wegovy's commercial. And what we saw was, I mean, these are like prominent figures within this weight loss commercial. They said that they're not exactly users of the drugs, but they're using their likeness. Keaton Thompson, DJ Khaled. I mean, this commercial in particular from Novo Nordisk's Wegovy definitely caught my attention because this wasn't alone. We also saw an ad from Roe around Serena Williams. I was really surprised to see her in the big game in this weight loss commercial as well. But Josh, it wasn't just AI during the ads. We also had a lot of tech executives also attend the Super Bowl as well. I don't know if you caught that, but there was Apple CEO Tim Cook was in attendance. He actually even, we see these pictures, but prior to the Super Bowl, he actually posted on Instagram a picture with Bad Bunny. In addition to that, also Coinbase CEO was in attendance. And then on top of that, there's rumors that there was something like more than 500 private jets that flew out.
Joe Pompliano had that stat.
Yes.
More than 500 private jets, Joe says, departed the Bay Area right after the Super Bowl ended.
They didn't even stay for the after party?
And reports, analysts estimate that more than 900 actually private jets arrived in the Bay Area between Wednesday and Saturday. And why not? If you can, of course you do.
Yeah. I mean, also now Starbucks, they had the free coffee today. I didn't see if Microsoft posted anything, but they're based in Seattle as well. So.
I mean, if you had the private jet. Although I will say...
We're still stuck on the private jet.
I will say, one time though, I was flying, I'm there in commercial, right? And there with me...
In commercial.
And the great unwashed, who's like right there, not even like economy plus, just sitting right there, Jack Dorsey.
Really?
The Twitter co-founder himself. Oh,
I haven't heard anything about him lately.
And there's a man who could afford a couple private jets.
Yeah, definitely.
Not for Jack, right there with Josh Lipton. All right, thank you, Brooke. Appreciate it. Well, after the Seattle Seahawks' big Super Bowl win, the next big thing on the horizon for the team could be a sale. The Seahawks expected to go for between $9 and $11 billion. That's according to ESPN. Jason Wright, former president of the Washington Commanders and managing partner at Ariel Investments, joined Julie Hyman on Market Catalyst to discuss the big game, the future for the Seahawks, and investing in women's sports.
If you are a true football fan, it was a great game. There's a mantra that back in my era where we said defense wins championships. In recent years, people have thrown that out the window. I think yesterday was a reminder that defense does indeed win championships.
All right, for true football fans, I thought it was also interesting that a running back was MVP, for the first time in 28 years? And you were a running back. Kenneth Walker III is the guy who got that nod last night. So I guess also as a real football fan, that must have been a fun moment.
Oh, it's sweet for us as former running backs in an era where people have said running backs have become obsolete. That young man played incredibly well and showed what it means to make the position prominent again. So we're all happy to see that. It was a great game. I really enjoyed it.
I'm curious to talk a little bit more about the business of the NFL too, because there have been some reports from ESPN that the Seahawks are now going to be up for sale after that, after the Super Bowl, and that could fetch the highest valuation ever for a team. I'm sure this is something you're watching closely. I mean, do you think would that be your expectation as well?
Unclear what's happening with the Seahawks. It's a complicated piece because of the estate and the owner of the team and being able to have it owned directly by an individual versus an estate according to NFL rules. There's a bunch of stuff around it. Either way, we're in an era where institutional investment has come into sports. And sports have professionalized in response to that. And interestingly, as a segue to women's sports, that's why women's sports is having a massive commercial moment on the heels of Caitlin Clark, where there's been great talent in the past. Now there are real solid business fundamentals behind it because sports has professionalized and there's an ecosystem to handle it. So whether the Seahawks sell or not, there will be other teams that sell in more rapid succession in the coming years because there is more interested capital and it's a true asset class.
So I'm curious about that, Jason, whether we're talking about women's sports or whether we're talking about the NFL and men's sports, the institutionalization, what are the sort of advantages and disadvantages? And on the disadvantage side, given that you're in the women's sports investing side, what are you guys working to try to avoid that might be some of the pitfalls of that institutional investment?
Yes, I think primarily it has been a positive thing. I'll give an example. When I went to the Commanders, it was still run more mom and pop, run like a local family-run business. And we had to bring in the right talent. We had to develop a proper revenue strategy, start to focus on EBITDA, really have business principles around it, not just to make money for the owners, but also to have a sustainable business that treats the players well and has proper facilities, et cetera. And that approach is what's needed in women's sports at this moment, where the talent on the field, court, and pitch has been strong for decades. We all have women's sports heroes. It never had the ecosystem built around it to make sure that those women's salaries could go up, that there was profit margin to provide that on a sustainable basis, and that you were building fans in a sustainable way. And so we aim to come in at scale in women's sports, high enough in the cap table to draw on my operational experience turning around an NFL team where we grew revenue over 50%, expanded EBITDA 9x roughly, to really drive that sort of productivity in women's sports.
And where do you see the biggest opportunities in women's sports? I know you all are invested in volleyball. You're invested in the Denver women's soccer team. Where else do you think there is room for growth there?
We believe that the opportunity both for our LPs and for the whole ecosystem to strengthen and be great for 30 years is in every part of that ecosystem. The teams in the mature women's leagues, we plan to invest in those just how we have at Denver FC, or Denver Summit FC, where we sold 8,500 season tickets and over 40,000 tickets for our home opener, which is amazing. We also see it in the real estate and real estate related businesses that surround it. Unsexy things like janitorial and parking that have great cash profile to balance out the returns that come from a team. And also make sure that you have world-class guest experience at these facilities. Also the leagues that could be next in high participation women's sports like volleyball, softball, track and field, flag football, and some others. Youth sports, which many are structured like private equity roll-ups with great economics that create the fans and the talent for what's coming next. And the technology businesses that surround it and make the P&L more profitable or the players more healthy on the field, court, and pitch. We're investing in that whole ecosystem because it's best for our LPs. We get real private equity quality returns, and it's great for the athletes and the fans.
Jason, I'm also curious about the sort of player power on the women's side. We right now are watching the WNBA players union, the negotiations with the players union, and we've seen some quite contentious women's sports negotiations on that front. Do you think that the leagues are recognizing what they have, recognizing the worth of the players? Do you think that the players, sort of where does the power reside at this point?
Yeah, I'm actually very excited to see the challenging CBA negotiations going on in the WNBA, because to me, as a former NFLPA rep who was our representative for the Cardinals during the 2011 lockout, the owners of the players, it means that women's sports has hit the big time and that there is enough economic and financial potential to be having real negotiations around this. So I think people should be unafraid of contentious CBA negotiations. That's the only way that they're done. It just means that women's sports has truly arrived. And I can't speak for every single owner, but I know that the reason we are investing in women's sports and want to be invested in basketball and football, global football and soccer and flag football and all these sports, because we believe they can be profitable enough to see women's salaries exponentially increase. When we've modeled out looking at teams in the WNBA or the NWSL and others, we model in a multiples increase on salaries because we know that we can run businesses in a way that can provide that and think that the whole industry can sustain that.
Love to see it, Jason. Thank you so much. Appreciate it.
My pleasure.
Coming up, Oracle's having a banner day thanks to an upgrade at D.A. Davidson. We speak to the analyst behind that call. That's next on Market Domination. Elon Musk is on a different mission with SpaceX as he sets his sights back on the moon. Yahoo Finance's Pras Subramanian joins us now. All right, so big picture, why is Musk making this pivot? Why from Mars to the moon? Is this IPO timing? Is this, this is just what's realistic right now? What's going on?
I mean, I think it's a combination, like you said. Let's start with the realism part, right? So Mars, as audacious as it was, getting out there, in theory, is completely unrealistic anytime soon, right? So you combine that with the IPO, right? That's sort of how I framed the story I wrote, is that why would you do it now? IPO coming up. Investors want clarity, they want a sure thing. Maybe you go small here, and the moon base is not a small thing, but at least you can get there in a couple days' time. And look, NASA is already planning the Artemis missions, right? The new ones that are coming up, they're going to go to the moon later in March, as early as March, in terms of like doing a mission around the moon with humans. Not landing just quite yet, but we're already doing it again. So it's not that far of a stretch for investors to look at and say, hey, moon is actually kind of doable here.
So how does the moon strategy, by the way, how does it fit into the broader Musk strategy? Because there's talk about the orbital data centers and XAI. How does it all stitch together?
So Musk is saying that if you have a moon base, so you construct that thing, you make that moon base, you can actually make stuff like radiators and solar cells out there for these orbital data centers. I guess there's a lot of silicon in the moon sand, so he says, right? So you can make these out there in the moon base, launch these satellites in a thing that he calls the mass driver, which is basically a thing that just shoots stuff into orbit. And because you're in a low gravity situation, you don't need a rocket. You can just launch it with this mass driver, launch these data centers and satellites and whatever you want out into space, to Earth, to Mars. I'm sorry, Earth and the moon, maybe Mars, I don't know. But that's sort of what he's saying there. The XAI part, like that's a little tricky, but maybe you can use that to harness design, planning, strategy, things like that on the moon with XAI. I'm just trying to say how all the Muskonomy works together, and maybe that's the component there for moon.
Inside SpaceX, Pras, now, what do investors focus on? What's making money?
So just looking at the numbers here, this is not official because they're not public, but SpaceX made 15 to 16 billion in revenue, 8 billion of that in profit. So what are we looking at here? It's launching payload. Launching in space is very expensive, and SpaceX has 90% of the market for that. So they have that business, and they have Starlink, which supposedly is the most profitable business, the most revenue generating is Starlink satellite internet service. There's talk of this Starlink phone, right? That could be happening. So I think we're going to hear more and more about that as the IPO sort of chatter heats up.
All right, yeah. Just Musk comments, by the way, on Mars, building a city there, 20 plus years out. There's your timeline for us.
I want to say one quick thing.
Yeah.
You can only launch to Mars apparently once every 26 months when the planets align. That's what Musk says. Whereas with the moon, every 10 days.
Yeah, there you go.
It's math.
Thank you, Pras. Appreciate it. D.A. Davidson getting bullish on Oracle, upgrading that stock to a buy as its ties to OpenAI and TikTok could pay off. Here to discuss is no other than Gil Luria, D.A. Davidson's head of technology research. Gil, always great to see you. So let's dig into this, Gil. You're upgrading your view on OpenAI and its orbit. In plain English, explain why, Gil, and why public market investors who are listening right, Gil, why should they care?
Well, yes, this really is about OpenAI. And if you've looked at the stocks for the last 6 months, what you've seen is that the market has decided that Google is the only winner. And then the whole OpenAI complex orbit is lost, right? So that's why Google has outperformed Microsoft, NVIDIA, Oracle so much over the last 6 months. What we're arguing is that Google is a winner, but the race is not over. And while OpenAI was meandering a little bit a few months ago, they are now far more focused on what they should be, which is ChatGPT and good frontier models. They're also now scared their investors into a very large round. Microsoft, Amazon, and NVIDIA don't want Google to win. They don't want Google to run away with AI. So they're now going to fund OpenAI with another $100 billion on top of the $40 billion OpenAI already has. So OpenAI will have time, it will have the capital to spend on more compute, ramp revenue. And the last thing we expect from OpenAI is that over the next few days or weeks, they're going to introduce a new model that's going to be state of the art. So it'll be better than Google's. So this whole story and narrative that Google has already won is going to be harder to tell when the best model is actually an OpenAI model.
When you say when you say state of the art there, Gil, I'm just curious, better than Google, how are you judging that, Gil? By what variables, by what metrics?
Well, we benchmark it internally. My colleague Alex Platt looks at the public benchmarks, and then he also runs the models to see how they compare. And so he has an up-to-date benchmark on that, and he expects that the next model from OpenAI is going to be top of the rankings for that based on external benchmarks as well as his benchmark. And then the publicly traded companies are the important ones right now. Since OpenAI isn't public, we're talking primarily about Microsoft and NVIDIA that are going to revert in terms of their stock performance when that happens. When OpenAI has the capital and has the best model, they should revert to the mean with Google, which is right now trading at a far higher multiple compared to Microsoft and NVIDIA and compared to its historical multiple trading range.
What about those, Gil, who say, and I'm interested to get your take on this, and we've had tech analysts on the show, they look at Google and they say, Gil, Sundar Pichai, he just has certain advantages over Altman. He's got that full stack. He's got the chips. He's got the cloud business. He's got the distribution. What do you say to that?
That's all true, which is why Google should be a winner. But if you look at a little deeper than that, ChatGPT has 3 times as many users as Gemini, and Anthropic is leading in the enterprise. Google Cloud just accelerated to 48%, but it's still smaller than Azure and AWS, and their ad business is growing slower than Meta's. So yeah, Google's a winner. They have a lot of structural advantages here, but they're not the only winner, and they're unlikely to be the only winner, especially if Amazon, Microsoft, and NVIDIA gang up to support OpenAI and Anthropic.
So the OpenAI story you're telling here, Gil, which is, as always, you make a compelling case. What are the risks for OpenAI, though, as you were writing this note and talking to your clients? What could go wrong for Sam Altman's company?
So the first thing was what was going wrong last year, which is they started to spread themselves too thin. If they go back to that, we would be concerned. Let's not forget, OpenAI went from having a good frontier model in ChatGPT to wanting to build their own chips and build their own data centers and have hardware and get into enterprise software and all these things that are superfluous and it's not well positioned to do. What we've seen them is come back to focusing on the frontier model and ChatGPT. If they revert back to spending capital on things they shouldn't be in, we'd be concerned. And then the other thing is you can't count the chickens till they hatch. Until they actually have the $100 billion in the bank from Microsoft, Amazon, and NVIDIA, it's not a done deal yet. So we're going to be waiting to see that happen, hopefully by the end of March.
Gil, I also do want to dig into this call on Oracle that you made, because I know, listen, you've been critical of Larry Ellison's company, but you now go to a buy. How come? Just walk me through it, Gil.
Well, Oracle went from trading at $345 on September 11th, which was a 45 times earnings multiple, to $143 as of Friday, which is an 18 times earnings multiple. So what the market did is say, not only are we not going to give you the credit for Oracle Cloud and the OpenAI business, we're going to actually ding you. We're going to penalize you for having a relationship with OpenAI. And we think that's taking it too far. Right now, the stock, Oracle, is really just trading based on the software business with almost nothing for all of Oracle Cloud, including this OpenAI business, when in other places like CoreWeave and Nebius, it's giving them full credit for the backlog. It's giving Oracle almost no credit for the same backlog from the same customers. So that doesn't make sense. So if OpenAI does well and has this positive catalyst of fundraise and top model, Oracle is the public company that's most closely tied to OpenAI and therefore should perform well as these catalysts play out.
I thought it was also interesting, Gil, just quickly, you did talk about TikTok USA, how that's sort of an underappreciated kind of potential tailwind for Oracle. How much does TikTok USA matter to Oracle, Gil, financially, strategically, and why do you think it's being sort of overlooked?
Well, I think there's just been so much activity around the AI part of the business that the TikTok was a quiet addition, but it was a windfall. They got 19% of TikTok USA for practically nothing. It's probably worth somewhere between $5 and $10 billion as is. But let's step back and think about what it could be worth. Of the $1.7 trillion of Meta, probably 40% of that's the US, $700 billion, and probably half of that is Insta, which is so $350 billion worth of value. TikTok USA, if you talk to consumers, they consider it almost equivalent to Instagram. And so it's not inconceivable to think that TikTok USA is going to be worth at least a lot more. than it is worth today. Not to mention that owning TikTok USA means that that part of the OCI revenue is secure, since they own 19% of that portion of TikTok.
Gil, as always, great to have you on the show. Thank you.
Thank you.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.